Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. Although Mohnish Pabrai is most known for his cloning strategy, did you know that he has two other investing strategies that he uses to his advantage? This week, I'll be covering Pabrai's Uber-Cannibals investing strategy. As stated by Charlie Munger, one of the investing heroes featured on this channel, pay attention to the cannibals. This quote by Charlie Munger highlights an often overlooked aspect of the stock market: cash-rich, undervalued companies that buy back shares on a regular basis, generating enormous value for shareholders. As a result, it's no surprise that Berkshire Hathaway's top holdings are consistent cannibals, such as IBM, Coca-Cola, and American Express. Companies that are constantly gobbling up their own shares are defined as cannibals. The strategy was founded on the simple premise that companies that aggressively buy back their own stock outperform the market over time. Pabrai defines an Uber-Cannibal as a business that is number 1, cash-rich, number 2, undervalued, and is number 3, consistently buying back shares. He believes that these three factors can generate significant value for shareholders. To put it another way, focusing on cannibals could pay off handsomely for us as investors. The best thing about a company's buying back shares rather than paying a larger dividend is that it avoids double taxation. To put it another way, the company pays taxes on its earnings, and you pay taxes on the dividend that pays you. Taxes on buybacks can be deferred to a later date, avoiding the double taxation of a dividend up front. Another option for avoiding double taxation is to keep large dividend earnings in a tax-free account. That way, any gains or dividends that you earn will never be taxed on your end, which can be extremely beneficial in terms of preserving our gains. To illustrate this example, you can see from this graph here the percentage of shares that are bought back by 3 of the large holdings by Berkshire Hathaway. The racing graph below shows the performance of an equal-weighted portfolio consisting of Berkshire-owned stocks of IBM, Coca-Cola, and American Express versus the S&P 500 in total return index from 1992 to 2006. If we were to look at the percentage returns each year from the Uber-Cannibals compared to the S&P 500, there are 3 things that we can learn from this comparison. Number 1, the first thing to notice is that there is a lot of fluctuation when investing in just a handful of Uber-Cannibals compared to the S&P 500. This means that as value investors, you have to have the patience, fortitude, and conviction to stick with your picks. Number 2, the second is that there will be years where you will definitely underperform the market again, testing your patience and convictions about your stock picks. Number 3, if you stick it out, the 24-year track record shows that the S&P 500 grew at an annual average of 9% compared to the Uber-Cannibals that had a 16% annual growth rate. This is a whopping difference of 7% on every dollar invested. Instead of looking at these numbers as percentages, let's convert these into real dollars to relate a bit better to the percentage returns. Let's look at these percentages as real dollar values over the course of 28 years if you had started off with an investment of $100,000. When Berkshire first purchased Coca-Cola in 1988, it was the only stock in the portfolio. When Berkshire first purchased American Express and IBM in 1995 and 2011 respectively, they were added to the portfolio. When IBM was added to the portfolio in 2011, it made up a third of the total. Coca-Cola and American Express, the remaining 2 constituents, kept their existing concentrations in the remaining portion of the portfolio. Over the course of 28 years, a $100,000 investment in the Berkshire Cannibals portfolio has grown into an incredible $4.2 million, while a similar investment in the S&P 500 has only increased by $1.5 million. That's a 4 percentage point gain on an annualized basis. This outperformance takes into account the significant drag caused by IBM's poor performance. Since joining the portfolio in 2011, IBM has delivered a paltry 1.3% annualized return compared to 11.4% from the S&P 500, a lag of more than 10% annually for the past 5 years. American Express fell from a high of $60 to around $10 during the financial crisis, a drop of 83%, before rebounding. Despite the fact that both stocks faced significant headwinds, the Berkshire Cannibals emerged victorious. Of course, you might be telling yourself, well, of course, it's easy for Warren Buffett to pick these stocks. He's the greatest investor of all time. But in Pabrai's article in Forbes, he has worked with his quaint Ying Xiao Zhao and found out the performance of 5 of the biggest cannibals over time. Encouraged by the dogs of the Dow strategy, also known as the puppies of the Dow or the Flying Five, and are the 5 lowest priced dogs of the Dow, where the dogs of the Dow are the 10 companies of the 30 in the Dow Jones Industrial Average with the highest dividend yield. Pabrai and Zhao only chose 5 cannibals to represent their picks. The good news is that, like the small dogs of the Dow play, you don't need to know which of the companies will be profitable to use this strategy. Simply set it and forget about it. It's crucial not to overthink this strategy or overreact to poor performance in a given quarter or year. Pabrai also advises against investing more than 10% to 20% of your savings in this strategy. This strategy is only viable if you plan to stick with it for at least a decade or two, according to him. The best place to implement the strategy is in your IRA. There are no realized gains to be concerned about this way. I encourage you to look at the Forbes article that I'll leave in the description below to find out exactly what those stock picks were from Pabrai and Ying Xiao Zhao. But the take-home message here is that on average, the Ubers beat the S&P 500 by 6.3% annualized. To put it another way, if you had invested $100,000 in the Cannibals in 1992 and rebalanced every year since 1992, it would have turned into $3.6 million, while an investment in the S&P 500 would have grown to $904,314. However, investing in the Cannibals requires some fortitude and a lot of conviction. It's important to keep in mind that the Cannibals underperform the S&P 500 in about half of the quarters. This is exactly why one needs to set it and forget it with this strategy. Every year since 2016, Pabrai has disclosed his fund's 5 cannibal picks on his website. Of course, you're all probably wondering, how does he find the cannibals? He thankfully leaves us with his Uber-Cannibal portfolio rules. This is the same exact rules that he follows to get his list of the top 5 Uber-Cannibals every year, as stated in the Forbes article. The Uber-Cannibal portfolio rules. Selection criteria. Minimum market cap of $100 million. Number 2, price per sales ratio less than 2.5. Number 3, the share buyback percentage over the dividend yield for the last 1 year is required to be greater than 2. Number 4, no insurance companies. Number 5, must have a minimum of 5% increase in trailing 12-month revenue over the previous year and 20% over the last 5 years. Number 6, the company must have reduced its share count by 3% in the previous year. Subject to the above restrictions, Pabrai elects the top 5 cannibals by share count reduction over the past 5 years. Rebalance methodology. Number 1, rebalance on March 18th of each year. Public companies are required to report year-end numbers by March 15th, so we're using audited year-end numbers. Number 2, the old companies that are not in the new portfolio are sold. The sell money is accumulated and distributed equally among all new entrants. Number 3, if the same company is present in our portfolio for another year, then we leave it unchanged. That is, no rebalancing trades. Some additional notes. Dividends are reinvested into the same company that paid it. If there is an involuntary removal through acquisition, delisting, bankruptcy, then the cash is distributed equally among the remaining cannibals. If there are any spin-offs, the shares are sold and reinvested in the parent. That's it. If you follow these rules every year, you'll be able to find the cannibals yourself. If you can't be bothered finding these out for yourself, Pabrai has promised us to disclose his top 5 Uber-Cannibals on his blog, chaywithpabrai.com, every year. If you want to screen out these Uber-Cannibals for yourself, keep in mind that while buying back stock at a high valuation is one of the worst things a company can do, there's almost nothing more beneficial to an individual shareholder than a stock buyback when the company's stock is trading at a discount to intrinsic value. And although Munger and Pabrai deserve their fair share of credit for bringing this strategy to light, the real OG of the share buybacks is Henry Singleton, the CEO of Teledyne. Despite having one of the most impressive track records in CEO business history, Henry Singleton is still a relative unknown to most investors. His track record rivals that of Warren Buffett and John Malone, and he belongs on any CEO's Mount Rushmore. Singleton's shrewd approach to capital allocation set him apart from most CEOs, a skill that many CEOs lack. Singleton used repurchased stock when it was undervalued as one of his main methods of allocating capital. When Teledyne announced its first tender offer for 1 million shares in October 1972, 8.9 million shares were received, and Singleton bought them all. Thinking it was a one-time fluke during his time as CEO, Singleton continued to buy stock, and at a time when buybacks were rare and despised by Wall Street, he eventually repurchased 90% of Teledyne stock. During his time as CEO, Singleton was a particularly astute stock buyer, generating an annual compound return of 42% across all tender offers. If you're interested in learning more about Henry Singleton, I suggest that you read Distant Force by G.A. Roberts, which has some very big gems hidden in the pages about how to create and operate a business in general. I'll leave you with a quote from Warren Buffett's 1980 Berkshire Hathaway letter to shareholders about his amazing cannibal strategy. Henry Singleton has the best operating and capital deployment record in American business. If one took the top 100 business school graduates and made a composite of their triumphs, their record would not be as good as Singleton's. Let me know in the comments below if you think I missed any key insights from Pabrai's Uber-Cannibal Forbes article in 2016. In fact, the data shown in this video is from that article and from his website. Thank you so much for watching, and if you get any value out of this video, smash the like button since that'll help grow this channel. Leave your comments in the section below and let me know your thoughts about this video and what I should cover next.